Hey, good afternoon. Thanks for joining us. I'm Danny Ratliff here with Lance Roberts and Richard Rosso, RIA Advisors. We appreciate you guys joining us today for this kind of end-of-year lunch and learn or webinar, I guess, so to speak. A couple full disclosures. We are Clarity Financial, doing business as RIA Advisors, a registered investment advisor under the Securities and Exchange Act of 1941. Anything we say today looks broad strokes, no specific recommendations. We've got a ton of questions we want to jump right into, 10 pages of questions. So if we don't answer anything of yours that's very specific, we're going to talk about a lot of generalities. If you do have a question and you have not submitted it, though, go to the Q&A. We'll try to get to it. If not, maybe we can get with somebody after the show or after this webinar and have a bit of a discussion. So just jump right in. Lance, Rich, it has been a crazy last week in the markets. We've got some news and information we're waiting for this week. I know everybody is looking forward to kind of understanding, what does this mean? Midterm elections, CPI, all the jobs numbers or the layoffs over the weekend. What does this all mean and where are we at?
So a couple of things. One is that this is something we've been writing about now for the last 4 weeks, I guess, is that we actually go back to mid-September. If you read our blog on a regular basis, we wrote an article in late September called "The Big Short Squeeze is Coming." And there's just so much bearishness in the market, so many people off sides that you were going to have a rally in the market. And we said then, all you need is just a little bit of good news. But going into the end of the year, you've got $5 billion a day in corporate stock buybacks through the end of the year. You've got 20% of mutual funds that have to rebalance their portfolios by the end of the year. And so there's just going to be a lot of offside positions that had to come back into the market. And then we wrote an article just about 2 weeks ago talking about, are the FANG stocks dead? And our premise there was simply that as soon as you see some signs of disinflationary growth in the economy, that money's going to rotate back into the traditional FANG stocks. Why? Because that's where all the passive indexing money goes to. 30 cents of every dollar goes to the top 10 stocks of the S&P 500. Those are your FANG stocks. And more importantly, those are companies that can grow earnings in a weaker inflationary environment. So, from that standpoint, the idea is that money can hide in Apple and Microsoft and Google, very highly liquid stocks. They have strong earnings, strong balance sheets. So that was where money was going to gravitate to. And again, of course, we saw a weak CPI number. It wasn't weak. We saw a decline in CPI. It came in a little bit weaker than expected, not surprising. The pig in the python of all that stimulus money that was injected into the economy in 2020, 2021 is now moving through the system. And so you'll see inflation come down. And so over the course of the next 6, 8, 12 months, inflation will be back to 2 or 3%. And that's just if the Fed did nothing, inflation would wind up there. The big question next year is whether or not all these rate hikes create a bigger problem for the economy.
So talking about rate hikes, kind of looking back at where the target rate was, obviously it's changed a tad bit. At least it looks like that may have been the case. Markets have gone higher. Everybody's questions are, we're getting a lot of them that are, hey, should we be all in? Should we be all out? What is the strategy for a portfolio? And I know you field these every day, but, maybe talk a little bit about, what we look for in portfolios for building that out. We have questions on, hey, we're in cash. Where do we go? Do we get back in? Or I haven't done anything and I need to, do I get out or do I just let it ride at this point?
Well, again, so daily market commentaries, weekly newsletter, daily blogs on the website. We write about this constantly, right? You can't be all in or all out. That's a bad decision because you'll get out at the wrong time. You'll get in at the wrong time. And that ultimately just leads to bad outcomes. One of the worst things that we see people do is constantly changing their models, right? I'm 80% stocks, I'm 30% stocks, I'm 70% stocks. Well, when they make those changes, they're always making those changes at exactly the wrong time. So the best thing to do is you manage your portfolio for risk. And we've been underweight equities all year long. We talked about, hey, we're going to have this rally, use this rally to sell into, reduce some risk, but it doesn't mean get all out of the market. It just means reduce your risk somewhat, raise a little bit of cash. That helps you kind of weather the volatility over time. But portfolio management's always a game. It's like football. It's a game of inches, right? It's not trying to throw a Hail Mary every single play. It's just trying to get those few inches down the field each and every play, keep moving the ball downfield until you score the goal. That's exactly what portfolio management is. And what people try to do is try to outthink the markets. And you can't. There's just simply too many things that are going on: geopolitical, geoeconomic, domestic political. These all have impacts on markets. What's the Fed doing? What's the Treasury doing? What are valuations? What are earnings? What are corporations saying? And there's simply just no way that you can factor all that into a portfolio and be all in or all out and try to time it right. The best thing to do is to mitigate the risk in the portfolio so it can grow over time without taking on excessive losses that can't be recovered from.
People get primal. I mean, we have lizard brains when it comes to this. We're not designed to invest. We're not wired for it. And what you think is going to happen doesn't happen. And by the time you make a change, the market's already way ahead of you. And that's the problem. I always try to tell people, like, our portfolios are at high tide or low tide, but we're not trying to suck out the ocean. Like, either you're in the ocean or you're not, but you're up to your neck or you're down to your ankles. You don't get out of the ocean. You manage risk. And I think when people hear manage risk in their own portfolios, they think it's all out or all in, as opposed to, accordion. It's like an accordion, like you ebb and flow it. That's risk management and working around the edges. And people get emotionally attached or they get detached. And again, it's just really, I had someone the other day that wants to go back in and miss the whole October run. It doesn't work. So you got to really understand who you are as an investor, how much time you have. And you also have to remember, like, if you don't have a financial plan or know what you're saving for, you're also rudderless. I mean, I don't know if you think you need a certain rate of return, but you don't know what that rate of return is, then you have no map. And I think you got to be anchored down to some numbers and know, okay, I need to get 3% return, or I need to get, as Lance says, I got to get a rate of return over inflation over time to hit my goals, because eventually I'm going to be in liquidation mode. I'm going to be living off this money, or I have a legacy to leave. So I just think about take the emotions out of it and create rules. And Danny, we know the 60-40 portfolio, Lance, one of the worst years since the 30s, right? Down 16%. Nothing's worked.
Right.
And that also has changed people's plans, and some of those traditional models didn't work. Doesn't mean they're not going to work next year, but this year it's been tough.
I was going to say that that excites me, actually. The interesting thing about it is that when you have a bear market in stocks, nobody wants to buy stocks. You have a bear market in bonds, nobody wants to buy bonds, but those are the best times to buy. And this is the hard part about portfolio management, is going against your gut to buy stuff when nobody else wants it. I get emails every day. I'm 100% cash. I'm 80% cash. And, I'm just going to sit here until I know better what's going on. Well, by the time you figure out that the buying opportunity occurred, it's so far behind you now, your next argument is, well, I'm going to wait for the pullback. And then the pullback comes, just like, well, now it's going to crash, so I'm not going to buy here. And then you don't buy it. And so then the market rallies again. And then as the market rallies, like, well, it's too overbought now. I can't buy it here. It's already gone up too much. I'll wait till the next big correction. And we've had people say that since 2009. I mean, we have people show up in our office today that have been out of the markets in 2009, now trying to figure out how to get into the market, right? So, this is the time if and I'm sure there's questions on our list about bonds and stocks. I mean, There's some great opportunities in stocks right now to buy. There's companies out there that have great balance sheets, high dividend yields, and are they at the bottom? Probably not, but are they close? They're getting there. As far as bonds go, if I had my dithers, I'd have 100% bond portfolio. I've personally been buying long bonds as well as leaps on treasuries, because when you have a recession or a disinflationary environment, bonds are going to perform, especially with such a big macro decline in bonds this year, the biggest since 1788. You don't get those bear markets but once a century, and that's your buying. Every time that's been a buying opportunity you don't want to pass up.
So, Lance, one of the things I don't agree with Lance on is the fact that we're going to be back at 2% next year. We're going to see each other a steak dinner.
All right.
Or beyond meat dinner.
2% on what? 2% on meat.
I just think that some of this inflation we're seeing on, yes, we're starting to see inflation peak, but to go from 8% to 2%, man, I feel like I'm on the track.
I said 2
and the train's coming at me. Yeah, train's coming at me. And I'm going to get hit here, because especially with energy policy and food, I just think that it's going to take longer for certain elements of inflation. Yeah, I want to go buy a pair of sweatpants or I want to buy a patio equipment from my yard. I'm going to get sales all day. But service inflation, what you're paying for people at restaurants to keep them, since the pandemic and the labor force participation rate, I'm just concerned that, like you said, the Fed's going to break something before inflation actually even comes down.
But if they break something, that's usually disinflationary, right? So that's going to make inflation come in faster. Sure. And then also don't forget that a huge amount of that inflation number we've got is a lagging indicator. So the one thing that hasn't come through to inflation yet is the decline in home prices. So once housing prices really start to show up in the inflation number, that's 40% of CPI just in homeowners equivalent rent. So when that housing number catches up and your year-over-year comparisons, which are high, start to match up, you're going to have a fairly sharp decline in rates. So,
how do wages affect that where labor force participation rate is now? I mean, wage growth still won't be where inflation is. That's why households are distressed. But don't you think that people will be doing whatever they can to keep the employees they have? Or what do you think about that?
To some degree, yes. But I mean, layoffs are coming. Layoffs are happening. Amazon's just going to lay off 10,000 people. Mm-hmm. Don't forget, at the end of the day, the most of the hiring that we did was that leisure, hospitality, lower end of the wage sector that are easily dismissible, right? I can get rid of those people pretty quick because there's always people I can hire back in that category. So that was where most of the expulsion of employees occurred, and most of the hiring back all occurred at that lower end of the scale. So, but again, wages haven't kept up with inflation, and wages aren't a factor of CPI, right? We don't have a wage component in CPI, but wages are a factor in terms of businesses. And ultimately, if the Fed breaks something, right, and you have much slower economic growth next year, that's going to be a pressure on corporate margins and earnings. And the way you get rid of corporate margins, way you protect corporate margins and earnings is to get rid of employment, which is your highest cost of labor or highest cost of your business.
Yeah, no, those are really good points. So the consumer's already strapped, though. I mean, if we look at the savings rate is at all-time lows once again, way below even where we were pre-pandemic. We have that's an issue. Credit card usage has gone through the roof. So what do people do with the savings that they do have? Big question we continue to receive is, I have cash. Where do I go without tying it up and locking it in so that they can take advantage of that opportunity that comes about?
Well, Danny, we've been talking about before the pandemic, financial vulnerability cushions. You know who's like the most late person in financial planning industry when it comes to advice? Susie Orman. She's the worst.
Oh, I know.
She comes out and she decides that now is the time for you to have a year's worth of living expenses in savings, right? Always late. We were there before the pandemic and we said, listen, you have got to have not only 6 months of living expenses for things that break down like your air conditioner or your automobile, but 6 months just in case somebody is out of work, wages aren't keeping up, whatever it is. So, and I feel like a kid in a candy store with some of these online banks because you're going to get better rates. No, they're not keeping up with inflation, but that's your emergency reserve is not designed to keep up with inflation. It is designed to be the buffer, but at least you're earning more on that buffer through Marcus and Synchrony Bank and Ally Bank. I mean, go ahead and pick them and look at those. Look at where you are. You got high yield, you got credit card, you got revolving debt. MasterCard came out with a report that spending on their network jumped 18%, right? To buy just the basics. If you have, credit card balances, pay them off. I mean, there are things that we can do in this environment to be more financially sound from a household perspective. But we talk about these online savings accounts and CDs all the time.
Rich is right. Just holding, this is the big thing, right? There's nothing wrong with holding cash. If your cash earns zero, who cares, right? When we talk about inflation and everybody's like, oh my God, I'm losing money to inflation. That's over like a decade, right? And when you're talking about very long periods of time, yes, you want to have your money invested in certain things and it'll keep up with the pace of inflation of time. But inflation doesn't matter over the course of 6 months or a year or whatever. And if you're going around and chasing some form of yield to try to match inflation or whatever, we see this all the time, is, people are just jumping into assets of some sort. It's like, well, I got to, inflation's this, I've got cash earning zero, I got to do something, right? Well, that worked out so wonderfully well for most people that were chasing the markets in 2020, 2021. They had to get into risky assets because there was no alternative, right? There is no alternative, Tina. And that's not worked out well for a lot of people. And the reason, the thing is that cash gives you opportunity. Cash is a risk-free asset that and what's the purpose of investing? I invest when I find a really good deal on something and I want to buy it, right? We shop for the best deals on televisions and cars and everything else. But when it comes to stocks, we just throw it in the market. But there's nothing wrong with just holding cash until you see it's the right time and you're comfortable and you understand what you're doing and you're putting that capital to work with a game plan that's longer than 3 months, right? So, if you're buying something today expecting it to immediately turn a profit, leave it in cash because that's not investing. You want to buy things that over the next 2 years, 3 years, 5 years, I'm going to make money. And right now, there's a lot of assets that I can buy today that 5 years from now, I'm going to make a lot of money on.
Looking out, building out the portfolio, and people have a really tough time right now looking at bonds, right? Bonds, we're going to go back to 1780s to find a time that they've been this distressed, and yet nobody wants to own them. And we've held on to some for a while, right? And but we're very underweight bonds at the moment. So maybe let's talk through, like, if people are looking for bonds, what should we be thinking about? We're short, intermediate, to type of credit. Is it agency backed? Is it munis? Is it corporates? Where are areas that we want to stay away from? And what are things that people want to look at in general? Just very broad strokes here.
Yeah, well, safer is always better. So at the end of the day, you kind of go down the risk curve, and treasuries are technically what you call risk-free. Then you move into mortgage-backed securities, which are guaranteed by the government. So it's Fannie Mae, Ginnie Mae. Then you start talking about corporate bonds, municipal bonds, et cetera. And the further you go down that curve, the more risk you take on. And you should be getting paid for that risk. And what we've seen over the last several years because of the Fed is everybody's piling into high yield credit, thinking that, well, I can get 5% yields, 4% yields, 3% yields on these credits that are junk. The high yield is a marketing term by Wall Street to sell you junk bonds. And junk bonds in general are companies that are on the verge of default or will have a very high propensity to default on their payments. And that's why they're called junk bonds. And investors have not been getting paid for the risks they're taking in junk. And, so when you start taking a look at the risk you're taking versus what you're getting paid, that's where you really got to kind of evaluate what you're doing in your portfolio. So, right now, there's no sense to, you don't need to take any risk really to get a decent yield on bonds. You pick up 4% on treasuries, 5% on high grade corporate bonds. You don't really need to go much outside that realm to generate a decent return for your portfolio simply from fixed income. And the best thing about bonds is they pay you back your principal at maturity. So even if you're wrong and prices go down, when they mature, you get all your money back.
Yeah, but Lance, so it's different than like exchange traded funds, right? Where we'll use those as a way to capture yields or yield play, right? We're looking at, I think with bond ETFs, almost you have to look at it for eventual capital gain, right? Not going to get my principal back. Or can you share a little bit about what the ETF versus, say, owning the individual bond or a mutual fund that owns one?
Well, no. So mutual funds, ETFs, right? Those are, just like we look at the stock market and we say, stock market is here, it's going to go here. And this is, if it goes to this point and I buy stocks, then I'm going to make this much money in my stock portfolio, right? It's the same thing with bonds. You benchmark your equities to the S&P 500, you benchmark your bonds to interest rates. So if you're looking for where interest rates are now and where you think they're going to be in a disinflationary, deflationary environment, recessionary environment, 23, then that tells you that right now bonds are undervalued. So if interest rates come down, my bond prices go up. So I buy bond ETFs for a capital appreciation play, plus I get yield. But importantly, to your point, Rich, you've got to sell the ETF where I don't have to worry about that with the individual bonds.
Multi-million-dollar question. Everybody wants to know, Lance.
Mm-hmm.
What are you going to do with duration?
Duration, we go long. Right now, if you take a look at our bond portfolio at the moment, so 60% of our portfolio is supposed to be stocks. We're basically about 38% to 40%, depending on whether it's ETFs or individual equities. On the equity side, balance of that is cash. In the bond portfolio, which should be 40% long duration bonds, we've got 9% long duration bonds. The other 31% are very short duration. So over the course of the next 3-6 months, as we start to see the Fed stop hiking interest rates, that's kind of the first clue. and start talking about this and seeing more of this kind of disinflationary trend come back into the markets, then we're going to start shifting more towards that long end of the curve. So taking all the really short stuff, the 1 to 3 month, the floater treasuries, all that stuff that we own, that's going to go long duration, either through TLT or even longer duration and something like an extended duration type holding.
Yeah, so full disclosure, we own TLT. We own some other bonds as well. Hey, we're also going to be giving out mugs. Kim Levine, we're going to get you one of these Candid Coffee mugs. Thanks for joining us. We appreciate you guys being here. Obviously, lots of great questions, great content for us, and great for us to use within our own practice as well. So let's jump into another question. You know, one thing that we've seen this last year is the dollar has just soared in value, right? It's been an interesting year to kind of watch it with all of these things that have occurred. I think if we would have sat down this time last year and wrote out a list and said, here are all the things that are going to occur in 2022, we probably would have been like, yeah, okay, maybe one or two, but probably not all of them. And here we are, right? Especially with the dollar, when many people have been thinking it's going to lose value. Where do we see this going? And, you know, there's so many things that are tied to it and asset classes. You know, how do you play this at the moment?
So I actually got into an argument with a guy over at MarketWatch this is probably the middle of it was very early 21. So I got into a Twitter fight with him on the dollar, and he was promising me that the dollar was going to go to zero. I said, no, the dollar's going to rally really strongly over the next couple of years, because what's going to happen is that as we have a global economic recession, in which is happening, then money's going to gravitate towards the U.S. because despite the fact of whatever you think about the U.S. in terms of capitalism, corporate stakeholderism, whatever you want to call it, you know, we're still the strongest economy in terms of the planet and where people want to store reserve currencies. And so it's just a function that the U.S. was going to act like a vacuum cleaner and just start absorbing global reserves. And that's exactly what's happened. The problem, of course, with a very strong dollar is that it's an anathema to every other economy in the world. So if you're an emerging market or an international industrialized economy, you buy everything commodity-wise is traded in U.S. dollars. So the stronger the dollar, the more expensive all your inputs are. And then anything that you buy from the U.S. that we manufacture is also costing you more because of the exchange rate of the dollar. So this has been a real problem for these economies. And this is why the dollar's now gotten to a point to where we're starting to see our government beginning to intervene into trying to bring the value of that dollar down. So we just recently saw the Federal Reserve open up dollar swaps with the Bank of Switzerland. There was a lot of problems, of course, with Bank of England. And, you know, we're not going to find out about much of this for another 6-9 months, but I'm certain we're probably going to look back sometime later next year and see that we were intervening into our currency to try to bring it down, because it's not healthy for global trade to have a very strong dollar relative to other currencies. Every you know, this was one of the big fallacies when President Trump was in office. He kept making all these claims that China is a currency manipulator. We've been manipulating our currency in the U.S. since 1913. So, you know, but this is what every country does, because we want to keep currencies somewhat in parity with each other, because that's what generates the best level of trade. It doesn't make things too expensive for China, doesn't make things too expensive for us, you know, whatever it is. So we try to keep some level of parity. And when they kind of get out of balance, then central banks got to intervene to bring that back down. And we do that by what we call sanitizing reserves. So China, as an example, sells $50 billion a year to us that we buy, you know, all their stuff, TVs and watches and whatever. Well, in order to stabilize their currency, they buy our treasuries instead of taking that currency, and instead of taking those sales dollars back into the yuan, they buy treasuries. This is why China owns a lot of treasuries of ours. And that's how they kind of keep that peg in somewhat of a balance to keep exchange going on an international basis. So, you know, but again, because everything else is weakening and you've got a place that you need to store reserves, that money's been coming into the US. We now have this imbalance. So next year, I would suspect that we'll see a much weaker dollar. That should bode well for emerging markets, potentially small businesses that have international. It'll bode well for international companies that have international sales. 40% of corporate sales come from international companies. So a weaker dollar should make our exports more attractive, which should help profit margins for corporations.
Lance, we also should see maybe gold work a little bit better
Yeah.
if the dollar edges up, right? Gold miners, you bring them up on fundamentals all the time. Like a lot of the gold miners fundamentally look pretty strong, and they've gotten battered here. So those are the opportunities that you might have as the dollar starts to work its way down, as the Fed needs to do that.
Yeah. Well, and that's right, because a weaker dollar is going to start to feed into any commodity, because again, we trade commodities in dollars. So a weaker dollar means that international buyers can buy stuff, they can buy more of that commodity cheaper as that dollar goes down and their currency goes up. So yeah, it should bode well. It should bode well for emerging markets, should bode well for commodity producers. That doesn't mean all of them, right? It's never a slam dunk that every commodity producer is going to go up. There's a lot of other factors that weigh into that: global demand, recession. Emerging markets are solely dependent upon exports for their revenue. So if we're having if we have a really bad global economic recession, which I'm not saying that's the case, but if we did, then that's going to impair. Even if you have a weaker dollar, that still doesn't mean that those sectors are going to do well, because they'll be impaired by a lack of demand because of a global recession. So it's not necessarily a one-for-one relationship. You've got to factor in the other potential probabilities of what happens.
Yeah, I think those are really good points, and essentially how correlated all these asset classes are. And I think that we've seen some things like gold that many thought would have already been working in this environment, but yet it's just been it's not down nearly as bad as the market. So that's going to be the next thing we're going to hear. But it hasn't been that non-correlated asset like it historically has been.
Yeah.
Rich, a lot of pink slips being handed out right now. A lot of questions surrounding retirement. What happens if you get, unfortunate event where, you're laid off, something happens, or you're retiring at the wrong time? What are the first things people need to be thinking about right now? What's the first thing somebody does?
Well, I think the first thing someone has to do is step back, because sometimes it can be very stressful, right? I wrote an article about 6 months ago called The Great Unretirement, where you have people that 55 plus who retired during the pandemic that are coming back. There's a whole article about it not too long ago in the Wall Street Journal. So part of it is, if you're going to retire in a time like this, even if you've done planning, if you had a plan done and you feel comfortable, going back to work, even part-time, just to lower your withdrawal rate. There's this whole myth. There are a lot of financial unicorns out there, and you can't kill them. Like, they don't die. They're like the Walking Dead. They keep coming back. And the one is the 4% withdrawal rule for distributions from your accounts. That always works, because taking a fixed rate from variable assets like stocks and bonds makes a lot of sense, like mixing oil and water. So now that it rates 2.6%. So what people are going to be worried about coming into retirement is cash flow, right? It's all the lifeblood of retirement. And what we might find, and Lance wrote an article about this not too long ago, is you might find that returns over the next decade or so are not going to be as good as they were over the past decade, because markets move in cycles. It's not always a bull cycle, right? But it's always a cycle. And if I'm withdrawing money out, I've got to be mindful of that. So the first thing I would do is just say, hey, I'm going to go through a life transition here. Say I'm going to get a severance package. I want to make sure that I've done a good job budgeting, examining my cash flow, and then seeing how much I need to live on, and can my portfolio sustain that in the kind of environment or headwinds that you might be retiring in. And we've been working on that since 2018, late 2018. We adjusted down the returns on all our asset classes moving forward. I just increased, which Lance probably doesn't know, using some work from Research Affiliates. I actually increased the returns on bonds, which would make him happy, in the overall asset class. So that's helped some of the tailwind, but it's not enough yet for us to change the returns on stocks. Because, Lance, wouldn't you say that even though valuations have come down, stocks are really not? I mean, yes, go inside the index and you'll find deals like you've been talking about, but overall, you're not cheap, are you, from a market perspective?
No. To your point, yes, there are some cheap stocks within the indexes, but the indexes as a whole, the market as a whole, is not cheap. I mean, you're still trading at north of 20 times earnings. And that's just simply a function of that we've had a price decline this year, but we're only, well, everybody's kind of freaking out. It's like, oh my God, it's a terrible market. I get it, but you're only down 15% for the year. I mean, it's not that big of a deal. You were up 26% last year. You were up 20% the year before that. You go back over the last decade, you've been cranking out 15% a year for 12 years. So you're down 15%, and this is the problem we talked about before. We have this really horrible behavior of anchoring to a high watermark. And we go, well, that's what it was, 4 months ago. That's where I am now. That's a terrible way to measure your portfolio. Look at it over 2 or 3 years. It'll take a lot of the angst, out of your portfolio management, keep you from making bad decisions. But, no, markets are still very overvalued. We've got work to go through. Next year with interest rates have already increased here. Profit margins are going to come down. We cannot maintain the level of profit margins that we had over the last year in the future. It's just, they're too high. They're just unsustainable at that level. So that's going to come down a little bit. That'll bring margins down a bit. That'll bring valuations down a bit. So a lot of this is just going to depend next year as to whether or not we're in a recession or not. Can we avoid a recession? Maybe, certainly, everything's possible. Nothing's a guarantee. And I think that's one of the big things that we need to be really careful of is there's a lot of people saying we're going to be in a recession, absolutely guaranteed next year. There's no guarantees. There's a lot of things that can happen. The Fed could reverse course and go back to dropping rates to zeros, restarting QE. A lot of things can happen that can change things. And so we need to be aware of that. Valuations are high. They should come down, and they could come down very slowly over a very long period of time, which, to your point, Rich, that would bring your return rates down to somewhere between 0 and 3%, before you factor in inflation.
And that's what worries me when you're doing a financial plan, is that I would rather have it, I would rather fall off a cliff than roll down a hill, because, right? Because I can, maybe like in a cartoon, remember when we watched cartoons, kid, there's always you always bounced, right? Yeah. But you're rolling down this hill, and at the same time, in your retirement, you're withdrawing money out and you're seeing your principal erode. That psychologically is going to weigh on you. Even if we tell you your plan is fine, don't worry about it. I have people right now, Danny does too, that they listen, do we have to do anything? Do we have to change anything? We're like, no, your plan works. But if you want to, you can reduce your withdrawals for next year, your percentages. And people are doing that just to feel better emotionally. Or they're saying, I'm working part-time. I don't really need the money, but it's nice having the cash flow come in. It's just that feeling of insecurity because they now have to live off this variable pot of money. One thing I will say before you ask your next question, Danny, is that marking to this high point is one of the worst things psychologically we see in portfolios. I have a portfolio that's a roller coaster, and you are going to time me to the top before the hill, right? It doesn't work. The only thing that's going to work if you don't want the downside risk are indexed annuities or annuities of some kind where I have zero risk of loss, right? I'm not going to capture all the upside of the market, but I'm not going to lose anything. Stocks very difficult to compound over time. You can lose your compounding effect rapidly. So these high points, Danny, you see it too, are just people think of stocks as something very stable and I should lock in this high point, and it's just not how it works.
Yeah, you get a little bit of both of those. And I think one of the things that we always come back to, and Rich and I probably sound like a broken record, is have a plan, update it. I see some guys on here that we've had conversations on, hey, how was this summer? Do you guys do any traveling? Oh, heck no. We pull back, most people do a pretty good job of saying, hey, you know what? We're gonna cut back a little bit here. We're not gonna spend as much money. Inflation's hitting everybody. The market is impacting many. And so I think you guys do a really good job of kind of being having that balance. But just keep in mind, when we look at these numbers, we want to stress them because we don't know what will happen next. Nobody does. In fact, Lance, how many times do you get asked, where is the S&P 500 going to be by the end of this year or next year or 2025? Nobody knows uncertainty. Nobody knew what was going to happen this year, right? Yeah. But we can use technicals to make very good adjustments to portfolios, decrease risk, increase it at different times, and we'll use that to our advantage. But one thing, before we kind of veer off into another subject, we saw a lost decade before, and we're hearing a lot of rumblings again that, hey, this could be a lost decade where we see this thing just falls off the cliff, like you just mentioned, Rich. Explain a little bit about what that means. And that doesn't necessarily mean that every investor it's a lost decade or that every year it's down for 10 years, but
No.
it just means what could happen within the markets, right?
Well, if I'm an accumulator, I'm going to be frustrated, right? I'm going to be putting money into the market and it's churning. It's not doing anything, right? But I'm not taking money out. I'm frustrated, but I'm not taking money out. If I'm in distribution mode, I'm a little worried because my assets aren't growing. But if I'm going to spend down, that'll work. With people we've built the plans for and we have prepared up front for a storm, they understand that because we've talked about it, that there could be a storm coming, and because valuations were at what, 45 times, and that's ridiculous. And eventually that wasn't going to work for them. Whatever the trigger is for valuations, which are terrible in the short term, was going to happen in the long term, because hopefully people we're working with are going to be in retirement 20, maybe 30 years. So we have to prepare them for how the ebbs and the flows. And so that's the psychological aspect of this headwind that you have, and that you might watch your distribution rates every 3 years. You're going to see how the distribution rates are going versus the portfolio. How is Social Security cost of living adjustments affecting it? How are things doing there? Do you have more guaranteed income so you don't have to take as much from the variable assets? When you have a variable portfolio with stocks and bonds, and I think Lance would agree, you just can't set this 4% withdrawal rule and forget it. You just can't. And we provide in our right lane classes, our inflation nation classes, we show people the detrimental effect of withdrawal rates on variable asset portfolios. So we make sure we're preparing people for that. But what it's nice to know, Danny, something you just brought up, when people saying they're cutting trips, they're going back to work, whatever, it's not because their plan says they need to. They are making the personal choice themselves to do it. They can continue on the road that we laid out, but they feel like they want extra protection. It's nice versus us saying, well, guess what? You can't go on vacation for like 5 years because I promised you 10% rate of return on your plan, and that's not realistic.
Yeah.
Right. So it's nice
we're
that
not ever
people are
gonna have
making
those conversations.
Yeah, I don't want to have that conversation where I have to have you cut something because you have to. It's because you want to, but you don't have to. And you got to tell people that over and over again. I don't have to? My friend over there, he has, no, you don't have to. Remember, we prepared for this up front. So headwinds are tough.
No, and I think that's that's a really good point. I think we talk about this frequently, is that when people are making distributions, we check in with financial plans, and sometimes it's more frequently when there's a lot of life changing events, or it may be an annualized type of deal, and we'll say, hey, where's everything at? How are we doing on spending? The times that I've seen somebody who's been unsuccessful, Rich, is typically when they've just spent too much. We'll have to say, hey guys, okay, was this just a weird year, or is this becoming a habit? And every now and again we're going to see a little bit of both, but we need to be mindful of that. So, big thing. Everybody is still wondering. We did this today, November 15th, thinking we'd have a little bit more clarity around the election and what that means and what that means for investors. And so, Lance, give us kind of a little bit of a bird's eye view as far as where we're at. I know we're still waiting for a couple things to come in here, and a runoff. So, what does that look like, big picture, for markets?
Well, typically, actually, if you go to our website today, realinvestmentadvice.com, there's an article posted, says, how do markets perform after midterms? And pretty much 100% of the time after midterms, markets perform better over the next 12 and 24 months. The average return over 12 months runs about 18%. The average return over 24 months runs about 33%. So that's all sounds great, right? But from the data when I wrote the article, the market was at 3,800. So the problem is that if you've been overly aggressive in the markets and you're down, with the market, 20, 22, 23%, which is where we were at the time that I wrote the article, this is, you get a 26% rate of return just to get back to even. So the big issue, and this is what we always talk about, there's nothing wrong with being down in your portfolio. The question is being down so much that the next, you spend the next period of returns just trying to get back. And, so that we always want to try to mitigate, there's no way to avoid the losses when the entire market's going down and every asset class is down. There's no way to avoid not being down, right? This has been a year. Bonds were down, stocks were down, commodities were down, gold didn't work, nothing worked. So no matter pretty much what you're invested in, unless you were just solely invested in energy, if you only bought energy stocks, you're doing just fine this year. But the problem with that is, back in 2021, we were talking about how nobody wanted to own energy stocks. They were the most hated asset class on the planet. They were beaten up. And we were like, hey, you need to go buy energy stocks because nobody wants them. Those turned out to be a great investment. Well, now that's all anybody wants. So odds on bet are that next year, you're probably not want to own energy stocks, most likely. You're probably going to want to own what people really hate, which is, by the way, bonds. So, but that's just the way markets work. Markets always tend to do exactly the opposite. And what investors do poorly is they wind up chasing last year's performance, right? So, last year, man, energy did great, so I better jump into that. Or this manager did great last year. I'm gonna go invest with that guy. And so you wind up jumping from the frying pan into the fire just kind of over and over and over again. And this is why, going back to your question a second ago about where's the market going to end this year? Who cares? Where's the market going to end next year? Who cares? It's not important. Picking a number and going, I think the market's going to end this year at 4,100 or 4,300, that's an anchor point. So here we're going back to doing one of our bad behaviors of anchoring to a number. And by doing that, the market's rallying. And we've been saying, hey, look, market's rallying here. Use this rally to raise some cash, take some money off the table, because we're going to have another down leg in the market, most likely as all these lag effects from the rates come through. Now, the next leg down will probably be the final leg. We'll probably be through the bear market and the next leg lower. But the problem is for people anchoring is like, well, Lance said that the market's going to get to 4,300 this year, so I'm not going to sell until we get to 4,300. Well, that's the problem. And then the market's going to crap out before you get to 4,300 or whatever, and you don't get sold out. You don't do what you're supposed to do. So forget about where the market's going to be. Forget about projections. The only people that are right about projections are meteorologists, and they're right for 3 days. That's the best you're going to get. Anything longer than 3 days is just a complete, what they call a wag, right? I mean, it's just, you're just guessing. And there's too many things that can happen. So when it comes back to, how to invest, where to invest, when to invest, just focus on what the markets are telling you to do, invest in those accordingly, and look for those opportunities that nobody wants, because contrarian investing more often than not works well, because when nobody wants something, then, and everybody's on that trade, everybody hates something, that's where the best opportunities occur. But it's also the time that you don't want to buy them, which is also a good indicator you should probably buy something. So
Lance, what would be good is to clarify that, only because we always say don't buy more into losers, because there are certain stocks that are down because they deserve it. Right. Peloton deserves it. Right. You got to be looking at the underlying fundamentals of things. And if you want to buy low, but you're looking at, hey, this balance sheet, income statement strong, you're doing that fundamental homework up front. But there are some companies you look at and you go, the market sort of got it right, that they don't deserve to be where they are.
Well, and there's a lot of companies that came public via SPAC or IPO or whatever it was, and they don't even have a business plan, and I said I didn't want to talk about FTX today, but it's a great example, right? Of, here's this 20-something-year-old kid, people were throwing hundreds of millions of dollars at him on a business plan that had no real structure to it. And now, you pay the consequence for that. So, but this is what happens when you have $5 trillion worth of liquidity injected into a market. You just, and look, we wrote articles in 2020, 2021 about, pet rock, digital pet rocks that people were buying, the NFTs of pet rocks. People were paying, massive amounts of money for digital real estate and ape, pictures of apes. And we saw people, every time money came into the market, they were chasing the most bankrupt stocks, Hertz and Carnival Cruise Lines and all this, thinking that, those were and you could just look at the fundamental balance sheets and go, this is a terrible idea. But it worked because you had all this money just with nowhere to go, right? Just money chasing assets. Well, now the course of the next couple of years is going to be assets trying to find money. And that's going to be more selective about what assets perform better than others. So to your point, be careful of the stocks that you do buy. Make sure that they do have income and revenue and cash flow, and low debt to income ratios are always helpful. Return on equity, those silly things called fundamentals will actually probably pay out better for you over the course of the next couple of years, particularly if we do get into a slower economic kind of disinflationary type environment.
And I want to make everybody feel better on this call. I want to make everybody feel better on this call, because there are some really alleged smart investors that gave money to this FTX guy. Like, what kind of homework did you do?
None.
Smart alleged guys of all these hedge funds and all these, like, as I see as the money arteries out into where, like, who invested into this group. And I'm like, really?
Yeah.
So believe me,
pretty interesting.
They don't have any edge over you, anybody on this call. They get sucked in, their emotions get out of whack, just like all of us.
Yep.
Human is human, lizard is lizard.
Well, since we broached the topic,
no,
do you see any systemic risk, contagion factor? No,
really? It's too small. It's the one thing about it, and I talked about this on the radio show this morning, is that the whole purpose of cryptocurrency and DeFi and all that was supposed to be away from the government, no government control, Wild West. And I was talking about that this morning, on the radio show, touched on a little bit last week. Prior to 1929, there was no regulation in the financial markets in terms of the stock market. Banks were loaning money to individuals to buy the IPOs that the banks were issuing. After the crash in 29, then we formed the SEC, said, oh, well, we probably need some regulation to keep the Wild West bandits, from stealing all the money from widows and orphans. And then we passed the Investment Act of 1940. After the crash of Enron in 2000, we passed Sarbanes-Oxley, because, we can't have corporations stealing money from individuals and pension funds and retirement plans. That's not right. So we passed Sarbanes-Oxley. After the financial crash and Bernie Madoff in 2007, we passed Dodd-Frank. Got to keep those evil companies from stealing money from individuals. Well, here you go. This is just going to lead to regulation for the cryptocurrency environment, which is all that anonymity you thought you were going to get. That's going to go away, because you can't have regulation you cannot have regulation with anonymity. In order to have regulation, you got to know where the money is. And in order to protect it, and especially on exchanges, just like Schwab and Fidelity and all these other institutions have SIPC insurance or FDIC insurance if you're a bank, and then plus excess coverage to cover your account. Why do they have that? Well, just exactly for this case. Something goes wrong with Fidelity, your assets are protected. Exchanges will have to do that same thing. So, a lot of these people, the guys at Binance are going, hey, we're welcoming regulation. Yeah, you're welcoming the regulation until you get it, and then you're not going to want it anymore. But it's going to be better for customers. It'll be better for exchanges. It'll be better for the market down the road.
A lot of questions about a recession here in 2023. What does that mean? That doesn't necessarily mean that the market just falls apart. If everything's kind of business as usual at the moment, markets have already seen a leg down. Now, granted, it can get worse. What should people be expecting?
Well, first of all, you have to wonder whether or not you're actually going to have a recession. So right now, nominal GDP is, running at roughly 8% annualized, so almost 9% annualized. So you've got to clip 9% of growth off the economy to get to zero growth on nominal basis. Now, on a real investment base, on a real GDP inflation adjusted number, we're much closer. Fourth quarter right now, according to the Atlanta Fed, is growing at 4%. So, there's a lot of talk about having a recession in 2023, but it's not a foregone conclusion. The Fed has never engineered a soft landing before, but it doesn't mean they can't get lucky this time. So, that's something we're going to have to deal with. Now, what's important about a recession, and as it relates to the stock market, is earnings. So if you start getting much slower economic growth, consumers contract, and this is the whole reason the Fed's hiking rates, right? I hike rates, why? I want to make the cost of money more expensive on you so you can't afford to buy as much. You buy less stuff, that's less demand. That means that in order for companies to sell things, they've got to lower the prices. You get disinflation or you get deflation, prices come down. So that's how you kill the inflation monster. So if that's the case, and that's what the Fed is trying to achieve, and assuming the Fed is going to stay on that tack until they actually achieve that goal, that's going to mean that earnings have to come down rather substantially. And right now, you're still looking at forward earnings estimates for the end of next year, depending on who you look at, between $210 and $230 a share. That is above the 6% long-term growth rate of earnings. So in order for earnings just to revert to the long-term mean, you're probably talking about a decline in earnings to somewhere between $160 to $170 a share. So that's a fairly deep decline in earnings, which suggests that prices will have to come down in the markets next year, another 15 to 20%, theoretically, to get those to line up. But again, it all depends on whether or not we actually get that type of economic slowdown that, should be the case based on higher interest rates and an aggressive policy from the Fed. But again, there's no guarantee on that. And you certainly can't invest on betting that that is going to be the outcome.
So we're going to give out one more mug. Fran Goldstein, thank you for joining us. Erica is going to reach out to you, get your information. We'll get you out a mug as well. We're going to do a little bit of rapid fire. So guys, if you have any more questions, I think, the ones we have here in the box you've answered, maybe not directly in the box, but Lance has covered. Quickly, structured notes. What do you guys think?
Leave them alone. Structured notes are basically a product where somebody is wanting to unload a position and they're selling you their position. So, these structured notes, they say, well, we're going to give you X barrier on the downside. We're going to give you X amount of upside if you buy this note. The problem, there's three problems with structured notes. You should leave them alone unless you really know what you're doing and what you're investing in. But these are sold as kind of guaranteed products. First of all, this is somebody unloading a big position one way or the other, right? So I've got a structured note on Apple. It's going to give you 10% of the upside or 20% of the upside, and you won't lose any more than 30% of the downside, whatever it is, right? So that's how the structure works. Well, if you're buying that note, why don't you just buy Apple, right? Just save yourself the headache. The second thing is these structured notes are big commission products for the guys selling them to you. That's why they're pushed hard. And third, they have no liquidity. So once you buy them, you cannot get out of them. And generally what you'll figure out, pretty early on is that whatever structured notes you bought is getting outperformed by something else in the market. And you'd rather have your money actually in the market. So these structured notes become very popular during bear markets because it's like, hey, you won't lose any downside, but you're really capped on the upside. Well, the whole point of coming out of a bear market is that's where you're going to get your best return. So why do you want to limit your upside on an investment where you have no liquidity? So just leave them alone. They're not worth the effort.
You know what I tell people? Create your own.
Yeah.
I got 50,000. I put in a structured note. I'll put 25,000 in Apple, and I'll put 25,000 in a 4% treasury.
There you go. Works great.
And I have liquidity.
Yeah.
And the commissions, to Lance's point, and if the market goes south and you want to get out of this, something goes wrong economically, forget it. Doesn't seem worth it.
Well, especially a lot of them claim they have FDIC insurance on them as well, right? Like the structured CDs, it'll be attached to, but they don't have it if you get out early. You need the funds. It's only if you wait till the very end.
And FDIC insurance is only accounts if they go bankrupt, right? So, or there's some fraud or some issue that's got to be bailed out. So that's really a negligible item when coming to making the investment. If you want something with a guaranteed return and no downside, buy an annuity.
Really? You have no downside and you capture some of the upside. To me, it makes more sense.
Yeah. Well, that's a great segue to the next question. So, a lot of questions about retirement income. How do you generate that right now? And really, you broached this earlier, Lance, about high yield debt. We're hearing more and more people trying to search for yield, even though we have it in safer places. But we're still we're saying, hey, should we be looking at these junk bonds? Should we be looking over here? Rich, Where would you look? Where would you start?
Where would I start? I would start with safety and liquidity first and work my way up. I've got to know what kind of cash flow I have to begin with. Like, what kind of cash flow do my investments provide me? Am I making the right decisions with Social Security? Do I have a pension? I want to look at all the different ways. Guaranteed income is more than dividends and other things. It's and corporate bonds, right? But what I find happens, and Lance does, and you do too, is people right now are going to get seduced by yield. They see big yields on things, and they don't realize how much risk they're taking to get it. Especially, like Lance says, we don't know if we're going to go into recession, but why would I want to own a junk bond? If they have debt and they have to refi that debt, these companies are going out of business. right? They had all these low rates. Now they're going to higher rates. That spells nothing but trouble for me. So if I want my cash flow to be reliable, even if it's lower, and I don't want to lose my principal. So I've got to be careful not to be seduced by yield. And you're seeing a lot of big fat yields out there that you need to be careful of. But by the way, if you go to realinvestmentadvice.com and you go to, we have actually guides available to other insights. And we wrote a guide to guaranteed income. It's rather extensive, but it'll give you ideas, how much you think you need, some rules of thumb we created to help you understand how to maximize your retirement income. And those are free guides for you at realinvestmentadvice.com. It might be worth for you to download that.
Yeah, in fact, Erica's just actually put some links to these things that we've mentioned within the chat. So if you go to the chat box, you can actually get a guide right there or a link to it. So a couple more questions before we finish off today.
Real quick, Danny, real quick. There's three things, and then this just to wrap up what Richard said. And when you're thinking about creating anything in your portfolio, whether you want income or growth or whatever it is, right? There's only three things that you can have in any investment. You have liquidity, safety, or return. That's all you can have. And you can only have two of the three. You can never have all three at the same time. So anytime, if anybody ever promises you can have safety, liquidity, and return in any one investment, they're lying to you, run away, because you can't. It's structurally impossible to have it. But if you need lots of liquidity, that's cash, it's equities, it's those type of things that you can sell immediately. If you are okay with not having liquidity, but you just want long-term returns, that's where you start thinking about real estate and annuities and things like that. If you're wanting, capital appreciation and that's most important to you, then that's your stock side of your portfolio. But once you start thinking about, okay, hey, I want an annuity, great, that'll provide you return and it'll give you some safety, but you've got no liquidity because you're locked up into it for a period of time. Well, I want a CD. That's fine. You get return, you get safety, but you have no liquidity because you got to keep the CD in the bank until it matures. So when I want stocks, that's awesome. You've got liquidity, you got return, but you've got no safety of principal. So you've got to start thinking about your portfolio whenever you start building it out. How does my portfolio give me all three of those items of safety, liquidity, and return? And how do I structure the build in a manner to, like Richard said earlier, I can build my own structured note. I can do that inside of the portfolio of creating safety, liquidity, and return and building it in a way to give me the income I want, give me the liquidity I need, and give me the safety of my principal over time. So there you go. Now go ahead.
No worries. All right. So the RIA portfolio is primarily comprised of U.S. domestic equities at the moment. Do you see other investment opportunities outside the U.S. in the future?
Yeah, we're probably, depending on how things shake out over the course of the next couple of months, we're watching the dollar, we're watching some other things. You're starting to see a little bit better performance out of emerging markets, but we've seen that before. We've seen these little flash in the pans out of emerging markets, small cap, mid cap. But over the last decade, basically being invested in emerging markets international, you've underperformed the whole market. So the issue for us is always, where can I create the best rate of return with the least amount of risk? And so far, that has not been emerging markets and international, not for the last 12 years. Will next year be different? There's probably a tradable opportunity. We may look at adding some of that exposure to the portfolio. But again, until it starts to show some real sustainable signs of life, it probably won't become a long-term investment. It'll be a trade.
Hey guys, we're coming up on the end of this today, but we do have a really good one, Rich. I think maybe you and I could use for Friday's Financial Fitness Friday show. So the question was, do annuities have the same long-term risk as a pension plan while the provider makes guarantees? How sure are we of their ability to provide those long-term? So I think that's a really good topic. Maybe we can cover for a segment or two. But hey, we really appreciate y'all's time today. We're going to continue to do more of these here in 2023. It's been a great, it's been a challenging year in so many different ways with asset classes, but it's really been great to interact with you guys and work with our clients. So we appreciate you all. If you have any questions, go to realinvestmentadvice.com, go to ask the question. We're also going to have a survey at the end of this, so you can give us some feedback. We'd love to have that as well. Tune in, go to YouTube. You can see us live there each morning, 6 a.m. or catch the show a little bit later. You can also go to any of the podcast distributors and find us there as well. AM 700 if you are in Houston, 6 a.m. We appreciate you all, realinvestmentadvice.com. Go check out Lance's newsletter. A lot of information, and really a lot of that you'll answer a lot of those questions along the way, won't you?
Yeah, as it says, like really, if you read our daily commentary, our blogs that we post on the website, and our newsletter once a week, all these questions, I've either written articles on them or commentary or answered them at some point over the last 3 months. So yeah, we keep it up to date for you.
Yeah, but we enjoy doing these as well. So we'll continue to give you this and love having the access to y'all where you can just kind of rapid fire shoot questions. So always good. But hey, thank you guys so much. If we don't see you or hear you or you don't see us, happy holidays, Merry Christmas. And we'll look forward to seeing you guys soon.
Bye.